economy on one side, which means there's not going to be any demand soon. But then we've got this Middle East situation, which may just send the price through the roof.
Yeah, historically, if you look at the conflicts in the Middle East, it has tended to be fairly buoyant for oil prices. This time, I think you need to look at it in sort of the context of what's been happening on the supply side as well. So, the forecast this year is that the output gap, so the excess supply is going to probably move up to about 2 billion, at least 2 million barrels per day. And that's...
2 million barrels a day?
Yeah. And that's,
so you can take Nigeria out of the equation and we'll still have equilibrium?
Pretty much, yeah. So it's... So we're looking at oil prices that probably will be suppressed for a while longer. If you look at the actual conflict that we're seeing now, I mean, this is obviously exacerbating tensions between Iran and Saudi Arabia. Now, both of those are obviously two of the 12 OPEC members. Now, the only way that we're really going to see a recovery of oil prices up to 80, realistically to $80 a barrel is if we see some sort of cut in production coming out of Saudi Arabia and out of the OPEC cartel. Again, with those sort of tensions that we're seeing at the moment, the likelihood of an agreement is actually becoming less. So with these sort of tensions, I would say that this almost guarantees that we're going to have a lower oil price at the moment. Again, like you said, anemic demand and just that increasing supply coming out of the Middle East still. So I don't see how we're going to see it. Most forecasts are around, between probably between $40 and $50 a barrel to average over the year, but with a lot of volatility expected.
Equities, especially after on Monday, one doesn't have no real reason to go overweight in equities, is it?
Yeah, well, yeah, it's been a very rocky start to the year, and it's really that volatile theme from December carrying on. It seemed like there was a little bit of a break over the quieter period, but definitely starting this year off heavily in negative territory. If you look at it, again, if you're trying to pick an asset class to invest in, I mean, if you're looking at equities versus bonds versus real estate versus the money market, we still think it's a fairly attractive place to be, actually, because at the moment, if you see what's happening in the US, look at the South African rate hiking cycle. I mean, we're going to be facing high interest rates this year. That's incredibly negative for property markets. If you're moving into the fixed income space, if you're going to go buy retail savings bonds, that sort of thing, you're kind of locking yourself into a coupon at a lower rate in the beginning of a rate hiking cycle. So rising rates aren't good for any investments, really. But I think you have to look at the equities over the long term as the asset class that does deliver the best returns and really stick with it. And it probably, again, I think it's become more of a stock picker's market. You've got to select your equities very, very carefully. But still, I think you've got to, equities is the place to invest. I'd rather be investing in a company that's going to share their profits with me rather than investing in something like a commodity where you're completely at the mercy of the supply and demand dynamic in the market.
What about unit trusts?
Unit trusts, again, it's interesting because unit trusts are equity investments, and it depends very much on the type of unit trust that you're looking at. So if you look at the unit trust universe at the moment, probably the theme that you've seen so far is that the smaller asset managers really have been outperforming dramatically compared to the larger asset managers. And I think that's very much, again, it's the discrepancies in the underlying market compared to the index. So if you look at what happened to our market over last year, pretty much flat, slightly up. I mean, total return, so if you include dividends, I mean, it was just over 5%. But if you look at the underlying indices within that, so if you look at resources, down almost 40% for the year, whereas industrials up 15%. So if you are smart about your stock selection, which you should assume your unit trust manager is being, they should be able to outperform the market, this kind of market fairly easily. So for me, I think active management probably is the way to go this year and probably the next 6 months at least. It does seem that they are outperforming at least the ETFs, so the more passive type of trackers. But really, it's the type of asset managers that you're selecting are the ones that are nimble and the ability to change and react to market dynamics that seem to be making the best returns.
Now, a lot of our fortunes are going to depend on what the dollar does. Do you think it's peaked?
Yeah, looking at the dollar index, I mean, that's really just taken off. So it's probably since about, I'd say, mid 2014, and that's really, I mean, if you cast your mind back to there, it's when we had the tapering. So yes. as the US started tapering and unwinding the QE programs, the dollar absolutely took off. You've had a fairly volatile, probably 3-4 months in the dollar index, but that dollar strength seems to be here to stay, and it's almost as if the market didn't believe that there was going to ever be an end to QE. That QE ended, and the dollar just perpetual strengthening. Now with the first interest rate hike coming through from the Fed in December, and really it looks set that this isn't going to be one and done, and there are going to be further rate hikes this year, I think that you are going to see an even stronger dollar internationally against the euro and definitely against emerging market currencies.
So one would be tempted to go for rand hedges, but now, even if you are earning in dollars, is the top line going to grow?
Now, yeah, that's a very, very good question. So if you look at how the rand hedges have performed, I mean, they've outperformed massively in rand terms on our local market, but a lot of that growth has just been a weakening in our local currency.
Yes.
If you just moved your money and put it in dollars, you would have probably made a similar sort of return. And again, I've got to say, it comes down to very intelligent stock selection. So if you look at the heavyweights on our market, the likes of Richmond, British American Tobacco, even SAB, if you look at, as you mentioned, the top line growth, so the actual ability of them to grow their sales has been very, very flat recently, and the enhanced earnings, so the enhanced profitability on the companies has come from them cutting costs. So they've become more efficient companies, leaner companies, but they are struggling. I mean, especially if you look at something like British American Tobacco, I mean, this is a monolithic company. For it to double in size is very, very difficult. So I would still say it comes down to stock selection and rather perhaps taking money offshore, going and buying smaller, more attractive companies, but in dollar terms. And also, even on our local market, some of the property stocks that have exposure to Europe or UK, so things like Capshop or Nepi, we still think are very attractive with the US raising interest rates, but still a very accommodative monetary policy coming out of the ECB and the UK.
Thanks for your time, Gary.
Good.
That's Gary Boyson from Rand Swiss. We're going to take a break now and then get more news from them.
Good, good. Thanks for coming in. Appreciate it.
No worries,
Okay.
no worries.
So have you been following the press conference yesterday,
Yes, I was there.
Oh, were you at the press conference?
Yeah,
Okay.
yeah, in Pretoria.